Hi there, I'm Mohammad Nizar and I'm from Tutorial 1 Group K. Today we'll be talking about the case study analysis, our assessment tree. And my group member includes Hao Cian, Brian, me, myself, and then Kevin. So the table of content consists of the introduction, the Liberty Syndrome background, analysis of break-even point and target profit, the potential effects of automation in terms of cost and profits, and the two potential non-financial issues of the company could encounter, and finally, the evaluation. So now we're talking about the Liberty Syndrome background. So what are they? They're actually founded in 2022. Their primary business is actually manufacturing and sale of food processing machinery parts. They quickly gained recognition for its flagship product for ZM2000. And this was actually impressive, and as they achieved impressive sales figures, surpassing 2 million in the first 2 years. And despite they had high sales, they declared losses due to high overall expenses compared to revenues. Now I'll be passing on to Hao Cian.
Thank you. Let's start with task 1. Task 1 is an analysis of break-even point and target profit. We need to use the data provided in Table 1 to determine and analyze the break-even point for the company in both 2022 and 2023. And we also need to calculate and analyze the quantity and value of sales required for the company to achieve a target profit of 200,000 ringgit in 2024. Next, please. So let's start with question A. Next page. So the test point of question A is to use break-even analysis to determine the company's break-even point in 2022 and 2023. And we will use these formulas to calculate. And the purpose of break-even analysis is to find out how much product a company must sell during a certain period to cover all fixed and variable costs. When the total revenue is equal to the total cost, the company reaches a break-even point. This analysis can help companies understand the minimum sales requirements to avoid losses. Next page. So to calculate the break-even point, we need to substitute the data obtained from Table 1 into the formula, and we can get the contribution per unit equal to 12.25 ringgit. The break-even point in units are approximately equal to 297,321 units. And we also get the contribution margin ratio equals to 0.35. So the break-even point in value equals to 1,466,228.57, because the fixed costs are the same in 2022 and 2023. So the break-even point in 2022 and 2023 are the same. Next, please. The company has been operating at a loss for both years because sales and units sold were below the break-even point. This could be due to factors such as selling price that is too low, high variable cost, or high fixed cost, either individually or in combination, which raise the break-even point and contributes to the losses. So the break-even point analysis help us clarify the company's minimum sales requirements in different years to avoid losses. And this is very important for setting sales targets and budgets. Next page. Next is question B. Next page. In order to calculate the target sales quantity and sales volume, we use these formulas. And in order to have a profit of 200,000 ringgit, our sales should exceed the total cost by 200,000 ringgit. So the total sales revenue equals to fixed cost plus target profit equals to 3,642,118 plus 200,000 ringgit equals to 3,842,118 ringgit. We use the target sales revenue to the two formula. We can get the quantity of sales equal to 313,148 units. And the value of sales equals to 1,977,657.1. 1. Next page. So the break-even point analysis help us clarify the company's minimum sales requirements in different years to avoid losses. And this is very important for setting sales targets and budgets. Next page. So the company needs to increase sales from 91,172 to 330,648 units, requiring effective marketing and sales strategies. And this involves strengthening brand promotion, expanding sales channels, and improving product quality and customer survive to boost market penetration and customer purchase intention. Raising a product price can increase unit profit and reduce the required sales value, but may decrease demand depending on price elasticity and competitors' pricing. Success depends on the market price sensitivity and maintaining competitive pricing to avoid losing market share. Okay, that's all my explanation, and then give the time to Nizar.
Okay, thank you, Halcyon. Now I'll be presenting question number 2. As predicted by Moses, if variable costs fluctuate by 10% in 2024, assuming no alterations to the selling price and fixed costs with a targeted profit of 200,000, the team must ascertain the amount of sales revenue needed to be generated in 2024 for both increase and decrease by 10%. The calculations that I've used is contribution per unit or margin equals to the selling price per unit minus variable cost per unit. And the required sales revenue is the fixed cost plus targeted profit or the contribution margin. So if the variable cost is minus 10%, the variable cost would be 22.75 multiplied by 90 to 100. I've got 20.475. So the contribution per unit is around 14.525 ringgit. So the required sales per unit is 3,642,180 plus 2 million divided by the 14.525. I will get around 264,522 units. So the required sales revenue is 264,522 multiplied by 35. I will get 9,258,270 ringgit. And if the variable cost is plus 10%, 22.75 multiplied by 110 divided by 100, I will get 25.025. And this makes the contribution per unit 9 ringgit 9.75. Now the required sales per unit is 3,642,180 plus 2 million divided by the contribution per unit I got earlier, which is 9 ringgit 0.975. I will get around 385,181 unit. The required sales revenue will be 385,181 unit. Multiply by 35, I will get 13,481 and 335 ringgit. So my analysis will be so we'll discuss how these changes in variable costs impact a company's financial performance. A 10% decrease in variable costs increases the contribution per unit. So the contribution margin is calculated as the selling price as per unit minus the variable cost per unit. With lower variable costs, this margin actually increases. With a higher contribution towards fixed costs due to decreased variable costs, the company can actually sell fewer units and still surpass fixed costs to achieve the target profit. Additionally, lower variable cost provides pricing flexibility. The company can actually maintain current price to increase profitability per unit sold, using the retained profit to reinvest in the business. Alternatively, it can lower prices to stimulate demand and increase sales volume. Conversely, a 10% increase in variable costs reduces the contribution per unit sold. With higher variable costs, the contribution margin decreases. This means that the company actually needs to sell more units to generate enough revenue to surpass fixed costs and achieve the target profit. To offset higher variable costs and achieve the target profit, the company may need to adjust its pricing strategy or increase sales volume. Increasing prices can reduce the demand, while boosting sales volume might require additional marketing efforts or expansion into new markets. In summary, managing variable costs is actually very crucial for maintaining a healthy contribution margin and achieving financial targets. Company must actually be careful to consider their pricing strategy and market expansion efforts in response to changes in variable costs. That's it for my slide. I'll be passing on to Brian. Thank you.
Okay, thank you, Mohammed. Now I'll be talking about task 3. Clearly explain the potential effects of automation in terms of cost and profits. The team must address the possible increase or decrease in total cost and profitability from automation. The application of relevant accounting concepts is critical in explaining these possibilities. Okay, now I'll be explaining the question. Next slide, please. Impact of automation on cost and profits. Now there are 4 sections to this, which is the initial impact and fixed cost, the impact of the subsequent variable cost decrease, the potential total cost reductions, and the increased profits and profitability. Next slide, please. Now, the initial impact of fixed costs. The introduction of automation necessitates a significant initial investment in purchasing machinery, equipment, and technology. This investment is categorized as capital expenditure, which is recorded as a fixed asset on the balance sheet. The cost of purchasing automated equipment is capitalized, meaning it is recorded as an asset rather than an expense. The cost is then spread over the useful life of the asset through depreciation. For instance, if a company invests $1 million in automated machinery with a useful life of 10 years, the annual depreciation expense would be 100,000. This depreciation expense is a fixed cost that appears on the income statement annually. Next slide, please. However, the fixed cost per unit might decrease if the company's production scales up. The fixed costs, such as the initial investment in automation, are spread over a large number of units. This leads to a reduction in the fixed cost per unit. Next slide, please. Now, the subsequent variable cost impact. Variable costs are costs that vary directly with the level of production. Examples include raw materials and direct labor. So automation typically would replace manual labor, leading to a reduction in labor costs. Since labor costs are often a component of variable costs, they fluctuate with the level of production, by the way, their reduction will lead to a decrease in the variable cost per unit. Total variable costs might still increase if they choose to increase their output due to better machinery. Next slide, please. Potential total cost reductions. Total costs will most likely increase due to automation being more efficient than labor and the company wanting to fully utilize the new automation to help them stop making losses. But as stated earlier, total and variable cost per unit have decreased as a result of automation. The total cost per unit overall will also decrease. Next slide, please. Now, increases in profit and profitability. So these two formulas have been explained in the earlier slides, so I'll be moving on to the explanation. As the variable cost falls with automation, the contribution per unit will rise. When the contribution per unit rises, it means that more revenue is being contributed towards clearing the fixed costs. The break-even point is now lower due to increased contribution. The company can now reach the break-even point faster than before and therefore increase the amount of profit that they receive. Now, an analysis of how the break-even point might work, if the new variable cost per unit went from $22.75 to $15, sorry, the break-even point from 297,321 units will become 182,909 units. Next slide, please. As stated earlier, the profit would increase due to decrease in fixed and variable costs. Variable costs falling means the gross profit margin will also increase. Using automation also helps improve the operating profit margin, even though the purchasing of machinery for automation goes in operating costs, which decreases operating profit. The increased capability and efficiency of automation will drive output and therefore sales up. Thus, it will also increase the operating profit margin. Next slide, please. In conclusion, if the automation proceeds smoothly, it can significantly reduce the variable cost for the company and potentially cause Liberty Sedaya Berhad to be more profitable. Lowering the break-even point essentially causes profit to be made easier and less profit has to cover up potential losses. The one-time setup cost may cause the company to not turn a profit at first, but the initial investment will likely lead to a decrease in variable costs, which over time will cause the company to become more profitable. Now I'll hand over to Kevin. Thank you.
Finally, we have task 4, which is to identify and address 2 potential non-financial issues the company could encounter as a consequence of adopting automation. So first of all, before we look at the issues, I would like to take a look at how these issues might arise. And one reason could be that they are not following the ESG, which are the criteria for sustainable investing when trying to adopt automation. So what is ESG?
So E stands for environmental criteria, which examines a company's impact on the natural environment. S stands for social criteria, which examines a company's relationship with internal and external stakeholders. G stands for governance criteria, which examines a company's leadership, organizational structure, and internal controls. So these are criteria one should follow before investing to ensure sustainability. And issues might arise if they don't follow these criteria, which we will be presenting. So these issues include fear of workforce displacement, which arises from not adhering to social criteria of the ESG. And we have also increased waste and pollution, which comes from not adhering to the environmental criteria of the ESG. So fear of workforce displacement. So since automation may lead to some current jobs and roles being redundant, this job displacement causes anxiety, fear, and dissatisfaction among employees. This can lead to lower morale and productivity, potentially leading to a hostile work environment if not managed carefully. Now, these are some ways to address that specific issues. The company could try having transparent communication and employee engagement. What I mean by that is by trying to communicate openly with employees about the reasons for automation and the measures being taken to support them. Involve employees in the planning and implementation process to reduce resistance and improve morale. And finally, to try to provide training programs to help employees acquire new skills needed for jobs created by automation. Another issue that might arise from adopting automation is increased waste and pollution. Since automation might lead to the generation of electronic waste and other types of industrial waste. So for example, once a machine has broken down without proper management, these waste would just be dumped on landfills without any care. So now, without proper waste management practices, this can result in environmental pollution, and it could even harm local ecosystems. To address that issue, we should try to implement suitable waste management practices. We could develop comprehensive waste management and recycling programs to handle e-waste and other industrial waste responsibly, like not just dumping them in a landfill. We could also partner with certified recycling firms to ensure proper disposal. So that would be it. We acknowledge the use of AI to research the background of the issue, research the accounting concepts / principle related to the assignment, and that will be all. Thank you.